welcome to lesson 3, guys. This is the new scalping strategy, one of my favorite strategies, and in fact one of my most profitable strategies. This strategy is different from any other strategy you will learn or any other strategy that I've talked about, for the simple fact that it's got nothing to do with technical analysis, candlestick patterns, or looking at chart patterns. This strategy has got everything to do with news release, right? Market moving news release. If you have looked at Forex charts for a while, you notice that once in a while, whenever there's some kind of market moving news released into the market, for example, GDP, unemployment data, interest rate data, this can cause a rapid movement in the currency price, regardless of the trend that has happened before that news was released. So in other words, you could have a currency pair that's on a very nice uptrend, right? And again, based on the trend, it should continue to go up. But suddenly there's some kind of news that's released. GDP was worse than expected, for example, or unemployment data was not favorable. And suddenly, boom, the price rapidly goes down, right, by many, many pips, sometimes even a few hundred pips, okay? At the same time, you may see that the chart pattern is on a downtrend. You think, okay, it's going to continue going down. And suddenly, again, some news is released and the price suddenly rapidly goes up by a few hundred pips. I'm sure you've seen that before. And that's why when you learn most strategies, people always say, avoid trading just before the news is released. Okay, exit the trade before the news is released. Because the moment the news is released, all the chart patterns and candlestick patterns can be thrown out the window, because news totally changes the dynamics of the psychology of the market. So the market could be really bearish, but if there's optimistic news, the mood can change immediately. And same goes for if the market is pessimistic, right? And there's good news, it can change rapidly. Now, the question is, could we, in fact, make money from this kind of news that is released that creates rapid price movement? The good news is, yes, we can. We can make money from this. But how would you know the outcome of the news that's going to be released? For example, we will know when GDP will be released. All this is in the calendar of events. But you've got no idea, will GDP be better than expected or worse than expected? You can't predict the news that's going to come out. Now, even if you can predict the news, you've got no idea how the market would react to the news. Right? You've got no idea, is the price going to rapidly go up, rapidly go down, or go no? You've got no idea. So the way to make money by scalping the news is to enter on the initial reaction and to get out really fast once that initial reaction is over. So let me explain the steps of this strategy. So again, like I mentioned, the FX news scalp strategy is a scalping strategy. The reason it's a scalping strategy is that we enter and exit within a couple of minutes. In fact, most of the time within 60 seconds. So it's a quick scalp of the market, right? So the scalp takes advantage of, again, rapid and large price movements driven by major market news within a currency pair. And we use primarily 1-minute candles to look at the market and to make our exit. So again, like I said, what happens is the market's going in a certain direction, right? And what I notice is that just before the news is released, again, say the news is going to be released at 9:30 p.m. Okay, and if you go to this website called Forex Factory, they've got a calendar of events that come out every day. So they'll tell you, okay, at 9:30, they're going to announce GDP. They're going to announce unemployment data. So everyone knows the time of that news release. And that timing is extremely precise. So you're going to make sure that your clock is set to the precise time in the world. Okay? So what happens, I found, is just before the news is released, about 3 minutes before the news is released, you find that the price of that currency in question starts to move with low volatility, right? So in other words, the pair could be moving rapidly like that in an uptrend, and 3 minutes before the news is released, everyone is waiting. No one knows what's going to happen, right? So the market becomes quiet. So the price goes into a low volatility range for 3 minutes. And the moment the news is released, okay, the price could suddenly move up rapidly, okay, if the result is very different from what was expected. Or it could, again, move down very rapidly. And you've got, again, no idea what is going to happen until it happens, because we can't predict the future. And of course, if the result is in line with what people expect, then it doesn't go anywhere. It goes sideways. All right. So there are basically three outcomes. Right. Goes up rapidly, goes down rapidly, goes nowhere. And rarely it does happen. Sometimes it could go up rapidly and go down rapidly, or go down rapidly and go up rapidly. So these are the different scenarios. But most of the time, it would either just continue going sideways, go up rapidly, or go down rapidly. And this is how we make money from this strategy. So basically what we do is this. We've got no idea where the market's going, right? We've got no idea the news. So we are going to place two orders simultaneously at the same time, 3 minutes before the news is released. So here's the idea. The market's moving in a certain direction, okay? The news is going to be released at 9:30, for example. So what I say, 3 minutes before the news is released, that would be 9:27, right? What happens within that 3 minutes? The market becomes really quiet. It's waiting for the news to come out. So during these 3 minutes, what I do is I place two orders at the same time. First, I place a buy order. And this buy order I place is a buy stop order. Right? And I place the buy stop order, for example, 12 pips above the current market price. So let's imagine the current price here, before the news is released, the price is, for example, 1.2850, for example. All right. So I'll place a buy stop order 12 pips above that market price. So 2850 plus 12 is 2862. All right. And now, so I call this the long leg because I'm going long. It's a long leg. All right. So I'm going to place a buy stop order at 2862 with a stop loss at the market price, which is 2850. Okay. So this is called my long order leg. Okay. So why? So if the price suddenly goes up, what will happen? If it goes up to 2862, it's a buy stop order, which means it is only triggered if that price is reached or exceeded. Okay? So if the price goes up by 12 pips to 2862, it would trigger my buy order. And I would buy at the current market price, which may not exactly be 2862. It could be slightly higher than 2862, but it will enter and fill somewhere at the market price. And so when I buy and it continues going up, I'll be making money. Okay? Now, what happens if the price, when the news is released, the price doesn't go up by 12 pips? Then this order will never get triggered. Okay, so I'll not be in the trade. What if the price goes down instead? Then the order again will not be triggered. So you'll only get triggered if the price moves rapidly in the up direction. Then my buy order gets triggered. Okay? Now, simultaneously, what if the price goes down rapidly, right? So at the same time, I'll place a sell stop order. And again, I'm going to repeat this again, right? Because you need to repeat it a few times before you really understand it. So I'm going to put a sell stop order, similarly 12 pips below the current market price before the news is released. So again, the current market price is 2850. So 2850 minus 12, what do you get? Okay. $2838. Okay. So I put a sell stop order at 2838. And again, this sell order, I call it the short leg, would have a stop loss as well. And the stop loss would be at the market price before the news is released, which is again 2850. Okay. So if the price upon news release suddenly rapidly goes down by 12 pips or more, what's going to happen? It's going to trigger this sell stop order, and I'll end up shorting at 2838. And as it goes down, I'll be profitable, making money, and I'll then exit at a certain profit. Okay. If the price again doesn't go down, it goes up, it goes sideways, the short leg doesn't get triggered, right? So basically, I've got a long leg, I've got a short leg. This will get triggered if the price goes up. This will get triggered if the price goes down. The price doesn't go rapidly in any direction. Both legs are not triggered. Okay, so wherever the currency moves, I'm going to make money from it. Now, some of you may be saying, can't be that simple. Yeah, it is not that simple, because sometimes the price can go up, can go down, it can go in many directions. So because of that, there are some things you need to do in order to make this strategy really profitable, and I'll teach you the specific entry and exit rules for this strategy. All right. So again, we expect the news to move the currency pair in one direction, triggering the long order if it goes up, or triggering the short order if it goes down. The winning position is then exited precisely 60 seconds after the news is released. Okay, so if it goes up, it triggers your buy order. The question is, when do you get out? So for this strategy, we have got no fixed target price. There's no fixed TP. Right? We exit 60 seconds after the news is released. Why? Because normally, after 60 seconds, the initial reaction is over, and the market then moves according to technical analysis. So we want to capture that initial reaction, okay, the initial surprise or disappointment. So 60 seconds, we're out, and we capture the profit from that. And again, if the news is extremely strong, I've seen that within 60 seconds, within 1 minute, it could move by 50, 100, even 200 pips in a certain direction. Now, what's the win rate of this strategy? The win rate is about 50 to 60%. And when you have a winning trade, there's unlimited profit. Okay, so I've seen profits anywhere from 1.5R to 5R on average. But I've ever seen an 11R profit before, but that's really rare. It can happen, okay? Now, the average hour loss, unlike most strategies where it's a 1 hour loss, for this strategy, you could actually lose less than 1 hour. It could be a 0.5 hour loss, but at the same time, it could be a 2 hour loss. And I'll explain why in a short while. But very simply, sometimes what happens is the price could go up rapidly and then go down rapidly, triggering both orders, and both orders hit their stop loss at the same time. So you end up losing 2 hour. And that's possible. It is rare, and there are ways to avoid it, but it could happen. It could happen, But bearing that, I can tell you that if you trade this strategy consistently, it is a very profitable strategy. So let's go into the nuts and bolts of the strategy to see how we can make it a very powerful part of our trading routine. So the first website that I go to is forexfactory.com. I've mentioned this in my previous videos. And this website would have a calendar of the coming events that will likely move currency prices. The first thing you need to do when you go to this website is to sync the website time to your local time, which is shown usually on your computer screen. So if you click on this clock, you will say, do you want to sync the time to your computer clock? Click yes, and it's synced to your local time. So that's really important. That's the first thing. Once you're synced in, you can take a look at the calendar of events for the coming week, the coming day. And you can see at the different times the news that's going to be released, as well as how it will likely impact the specific currency that pair. Okay? So for example, you can see at 5:30, there's going to be manufacturing PMI news that will likely affect the pound currency. and it's a red news. So notice that there are three colors. There's yellow, there's orange, and there's red. And we are only interested in trading red news. Red tells you it is likely to affect the currency price in a significant way. You're going to see a major movement in the currency price. We're not interested in orange or yellow news. Again, you're going to see many red news every day, and obviously we're not going to trade all of the red news. We only trade 5 major news announcements with specific data. Now, I can't emphasize this enough. When you trade news, the news must have specific data. What happens is before the news is released, analysts would give a projection on the kind of news. For example, they may say, we expect the manufacturing PMI to be 56.6. So that is specific data, 56.6. So if it is more than expected, like maybe it's at 70, the price may move up rapidly. If it's like 40, it moves down rapidly. So that's what I mean by specific data. There are some news that are red news, but the data is not specific. For example, they may say red news, Janet Yellen, the Federal Reserve chairperson, is going to speak. Or the chairperson of the Eurozone is going to speak. Okay? Now, we never trade on those news because when data is not specific, the price will not move specifically in one direction. It may whipsaw based on what that person says. So we only trade specific data. Not only that, there are 5 major news announcements I tend to focus on and not the rest. Okay? So what are the 5? The first would be non-farm payrolls, known as NFP. Number 2 is CPI, Consumer Price Index, that basically is inflation data, tells you the inflation of the country. Next would be GDP data, unemployment claims, and interest rates. Are they going to raise interest rates, drop interest rates, maintain them steady? So these are the 5 major news that I trade only, and they again must have specific data. All right. So for example, you can see on this particular day, we have got at 9:30 p.m. 3 things coming at the same time: employment change, GDP, and unemployment rate. So 3 major news at the same time is red. Is going to affect the Canadian dollar. All right. So that is kind of news that I would trade. All right. So which pair do we trade? Recall that when we trade currencies, we can't trade one currency. We always have to trade in a pair of currencies. So for example, if there's a pound news, you can trade the pound US dollar pair, the pound yen pair, the pound franc pair, right? So which pairs do I trade? So for any news that's related to the US dollar, you can trade any of the US dollar pairs, like Euro US dollar, dollar yen, dollar Canadian, dollar franc, and so on and so forth, okay? Now, I used to trade very often the Euro USD when it comes to US dollar news. So in some of the videos you may see later on, you notice I use the Euro US dollar pair. But recently I found that trading the dollar Canadian pair or even the dollar yen pair for dollar news is a lot more effective, right? For some reason, the dollar Canadian and the dollar yen moves a lot more rapidly than the Euro US dollar when it comes to US dollar news, okay? So because of that, I would suggest that any kind of US dollar news, right? Anything to do with the US dollar can trade the US Canadian pair or even the US yen pair. I prefer the US Canadian pair. Okay, so that's for US dollar news. For pound news, obviously you trade the pound US dollar, right? And Canadian news, again, US dollar Canadian, yen news, dollar yen, Euro news. Now, obviously, if it's Euro news, you trade the Euro US dollar. Okay, franc news, dollar franc, New Zealand news, New Zealand dollar, and Aussie news would be excuse me, Australian dollar, right? So to summarize, basically, if it's the US dollar news itself, I trade the dollar Canadian. Okay, for any other currency, whether it's Aussie or franc or yen, I trade the dollar pair with that currency. Right, some important points in trading this strategy. Number 1, only use forex brokers with very tight spreads of 1 to 2 pips. that use an MT4 platform, or you could use MT5 as well. Although I must say I've never used MT5, I tend to use MT4, so I'm more familiar with the MT4 platform. So if you've got questions, please don't ask me about MT5. Never used it before, but you could use it as well. And what's important is your forex broker has to allow you to place two opposing orders on the same currency pair at the same time. Not all forex brokers allow this, so you have to ensure that your forex broker allows you to do that, right? To place a long order and a short order on the same currency pair at the same time in order to trade this particular strategy. Now, I can't stress enough that having reliable internet connection is really important for this. In fact, some of my students are so paranoid when they trade this strategy is that, as they're trading using a certain internet Wi-Fi, they've got a secondary Wi-Fi on standby in case the first one dies. Now, I'm not that paranoid, but I would not dare to trade it in if I'm traveling overseas, I'm in a hotel, if the internet connection is not stable, I will not dare to trade this strategy, because if the connection is lost halfway, it could mean a loss instead of a normal profit on this strategy. Now, personally, some of you know I use halifax.com.au as my forex broker because they do not mark up on their spreads. So I've got very tight spreads of usually 1 pip or less, maximum 2 pips. But you can only use Halifax if you're a non-US citizen. Do also know that Halifax offers a special education credit to my students. So if you take any of my courses and you use Halifax brokers and you fund the account, they actually give you a $500 credit into your account to help you to pay for your education. So, and they give you a special rate for my students as well, so you could check them out. Now, if you are a US citizen, you can't use Halifax, but you could consider another US regulated broker that have these same features. You could check out forex.com or Oanda or any other forex broker that you check them out. All right. So again, let me explain again the entry and exit rules one more time. So like I mentioned, we place our entry orders. Again, there are 2 orders you place, right? The long order and the short order. The long order is a buy with a stop loss. The short order is another buy, it's a sell with a stop loss. Okay? And we place these orders precisely 3 minutes before the news is released. So again, if the news is released at 9:30, we place the order at 9:27. So again, why 3 minutes? Why not 5 minutes? Why not 10 minutes? Why not 1 minute, right? The reason is because 3 minutes is optimal. If you place the order too early, the price could still be very volatile. So it could trigger one of your orders even before the news is released, okay? And obviously, you do not want to place it only 1 minute before the news is released because you may not have enough time to enter the order. So 3 minutes is the optimal time. Please stick to that rule, okay? So again, let's assume that this is the timeline. And at this point, the news is going to be released at this point. So again, when it's released, the price could rapidly go up, go down, or it could go nowhere, all right? And so what happens is 3 minutes before the news is released, you look at the market price at the time. I call that the current market price before news is released. So let's assume that at news is released at 9:30, right? So when do we look at the market price? We look at it at 9:27. Right, so again, that's 3 minutes. So at 9:27, what I do is I look at the current market price. And let's assume the current market price is 1.2850 or simply 2850. So what do? I would then place, first of all, my long order or my long leg, okay? So for my long order or my long position, I'll place the buy stop order 12 pips above the current market price. So it'll be 2850 plus 12. That'll be 2862. And I will attach a stop loss for my long position at the current market price, which is 2850. Okay? So there we go. So again, I'll place a buy stop order at 2862, which is 12 pips above the market price, and the stop loss would be placed at the market price. Now, I'll mention this later on. Now, questions, some people ask, why 12 pips? Why not 15? Why not 30 pips? Why not 5 pips? The reason I place it at 12 pips away is because I have found that if there's no strong news, if the news is not strong, the price would tend to fluctuate within a 12 pip range. That is the normal volatility. Okay, so only if the news is strong will the price move more than 12 pips and hence trigger our order. Remember, we only want to get in if the news is strong. If it is not strong and the market goes as per normal, we do not want to get triggered, and that's why it's 12 pips. Now, I found that for most currency pairs, 12 pips is a pretty good distance. Okay, but if I'm trading pound related news, the pound currency, the pound tends to be more volatile. I'll tend to put it about 16 pips away, 1/6 for pound pairs. All right. Now, simultaneously, I'll put a sell stop order 12 pips below the current market price, which would be 2850 minus 12, that would be 2838. All right. And attach a stop loss for my short position at the current market price, which would be also 2850. Okay, so as you can see, this is the long order, this is the short order. And again, like I mentioned, for pound news, I'll use the pound dollar and I'll use a distance of 16 pips up, 16 pips down instead.